If you ask a traditional financial advisor what you need to do in order to retire, they're going to tell you to use the 4% rule. As a late investor, this isn't going to work. Why? Because the stock market is volatile. It's not going to go up steadily. And we don't have generally 30 years of investing to fall back on.
But don't panic. Stick around, because Shell is going to show you the exact cash flow strategy we use instead.
But the truth is, the stock market is volatile.
Yeah, and standard index funds haven't kept up. They are actually kind of low, sitting between a 1.5% to 2.5% dividend yield.
Exactly, Henry. This works if you've been investing since you were in your 20s. But for late investors, we don't have that time factor. And for many of us, we are looking at using the stock money in about 10 to 15 years. Some of us might want to retire even earlier than that.
It forces you to sell your shares just to cover the money that you need.
Exactly, Henry. That is nowhere near enough money to cover your everyday life expenses. So what does the 4% rule actually end up doing? It forces you to sell your shares in order to cover any money that you might need. And this creates a horrible cycle because once you sell those shares, you no longer have them. And so less shares equals less money each month. And if the market goes in a steep downward trajectory, we don't have the time to replace those shares that we have lost. In the finance world, this is called sequence of returns risk, also known as account drainer. So what is the alternative to selling off your hard-earned principal? Investing in high-yield dividends and stocks. Wait, hear me out. By utilizing covered call ETFs like QQQI and SPYI, we are building cash flow. We aren't relying on selling our shares to survive. These funds generate massive monthly distributions. This means that our portfolio is giving us dividends every month that we can use instead of selling our shares. We transition from making money to safely spending it.
Which means we don't have to stress about a market crash, right when we actually need the cash.
Exactly, Henry. So how do we build this cash flow machine? Well, there's a few simple steps that you have to follow. Number one, everything's going to be happening in your Roth IRA. And the reason that we do this is because whatever you add in there or you reinvest, it's all tax-free. So every penny is going back into that position. Now, the next thing, you want to make sure that you're looking at high-yield dividend ETFs or stocks. Please do your own due diligence because there are some that are pretty risky and not worth it. So you want to take the time out to kind of look for yourself, ask a financial advisor, whatever you feel most comfortable with. I am not a financial advisor, so this is just what I have been doing. Okay, number two, you're going to reinvest your dividends into that position. And then number three, you need to add money to it regularly. For me, I invest every month. Now, obviously, the more, the better. And we're going to see in a little bit some different scenarios depending on how much you can invest. For myself, right now, I can only do $200. But that is $200 split amongst my regular investment and my Roth IRA. Little quick plug-in, if you're interested in finding out about that, make sure to subscribe because I will be sharing my total stock portfolio where I go over everything in a few weeks. Now, lastly, a very important piece to this puzzle is that you don't invest in just one high-yield ETF or stock. You need to invest in at least two, possibly more if you can. And the reason is because you want to make sure that you are diversified amongst your stock portfolio. Because one ETF or stock might be holding in one type of sector, and if that one is having a downward trend, you need the other one to hold up your stock portfolio. So it kind of keeps it balanced. Okay, let's look at a few different scenarios of how this looks, just so it gives you more of an idea of what you could expect. Now, since we are talking about late investors, we're going to use the scenario of someone that's 45 years old. So you're 45 years old. You buy exactly one share of QQQI and one share of SPYI. Right now, that costs you about $109 total. From that day forward, you decide to add $100 a month to QQQI and $100 a month to SPYI, a total of $200 a month out of your pocket. If you do nothing but reinvest the dividends and make these monthly contributions until you are 60, Here is what happens. Your QQQI position grows to roughly $60,000, paying out about $700 a month. Your SPYI position grows to roughly $50,000, paying out about $500 a month. Without selling a single share, that $200 a month habit has built a portfolio kicking out $1,200 of passive cash flow every single month. Now let's break it down even more so you can see it. So you're starting out, you have $100 into QQQI and $100 into SPYI. You're reinvesting all your dividends and you're adding $200 monthly. So now you're age 50. Your out-of-pocket is $12,000. Total value, $16,800. Passive income, $183 a month. Okay, year 10, you're now 55. Your out-of-pocket is $24,000. Total value, $49,060. Passive income, $536 a month. So you decide after 15 years, you're going to go ahead and start taking out the money. So you're now 60. Your out-of-pocket was $36,000. Total value, $110,600. Passive income, $1,212 a month. Now you're definitely at that point where it's like, oh, well, wait a minute. I can't retire off that. No, but it could be more like what I'm doing where it's just going to be supplemental unless I am able to add more.
Wait a minute. The QQQI pile made more money because the yield is higher. Why don't I just dump all my cash into that one and buy a yacht?
You would think that would be a smart move, right, Henry? Where if you put all your money into QQQI, since it has a higher dividend yield, it's going to grow faster. But that's a trap. What may happen, and quite often does happen, is that one sector does go down, which I had mentioned just not too long ago, is if you put all your money into QQI, then all the growth that you have can dwindle, and it's going to take you time to build up, which you don't have. Okay, let's see the difference is if you are fortunate enough to be able to put more money into it. So this one is going to be a more aggressive strategy, and you're putting $1,000. So $500 to QQQI and $500 to SPYI. So everything else is the same. Now you're 50, your out-of-pocket is $60,000, total value $84,000, passive income $915 a month. Okay, now 10 years has gone by, you're 55, your out-of-pocket is $120,000, total value $245,300, passive income $2,681 a month. Now you hit that 15-year mark, you're age 60, you decide you're going to start taking some of that money out, and you are out of pocket of $180,000, total value $553,000, passive income $6,060 a month. For many of you, that would be enough for you to retire. And remember, this is your dividend income. So as you can see, if you are planning on using money for your retirement, you definitely want to have your money in a Roth IRA, and you want to ignore the 4% rule and just start investing in high yield dividend stocks or ETFs. And that way it will build that cash flow for you. And when it's time, you can take that money out. And you can see if you're able to put $1,000 in, man, you can basically retire at the age of 60, starting at 45.
These scenarios run on a 10% to 14% dividend yield, which is what you'll typically see with covered call ETFs like QQQI and SPYI. But there is a catch. You need to watch out for net asset value, or NAV erosion, to pay out those massive yields. These funds cap their upside growth, meaning the actual value of your underlying shares can slowly shrink over time. To prevent NAV decay, reinvest your dividends and add money to your position.
I want to reiterate that this is just a plan. I am not a financial advisor, so definitely do your own due diligence and finding out what you feel comfortable with doing. Everybody's different. It's your portfolio. It's your money. Do what you want with it. If you watched to the very end, thank you so much. I really do appreciate it. Until next time, bye.